Asia ex-Japan long-only portfolio with a 4% weightage, and he will trim his weightage for that in the Samsung Electronics preference shares and on SK Hynix, and also in the India long-only portfolio with a 4% weightage. That will be done through removing the investment in AU Small Finance Bank. So as of now, both Siemens and HDFC Bank are on Chris Wood's radar.
Okay, thank you very much for that. And that leaves only a few seconds for the markets to open. So let's not get any more analysis going, but just look at how the markets have opened. It's opened very, very flat. Oh my God. A tinge of red is across. The Sensex down about 47. Now down 73. And it's getting a little redder. And the Nifty is down about 21. It still amounts to only a 0.1% loss on the big boys. And the mid-cap is a tad redder, down about 0.25% at this point in time. And the Nifty Bank as well, down about 0.2. Let's see what's the green on the stock markets. Adani Enterprises is in the green, starting about 2% higher. That's the biggest gainer on the Sensex and Nifty. Bharti Airtel, again, up about 0.6. Adani Ports, Nestle India, Hero Moto, ITC. Well, there doesn't seem to be much of a method or any fundamental reason why these stocks are up. Shriram Finance is up about 0.2. Sun Pharma, Ultratech Cement are the other ones that are in the green. Obviously, the red list is longer, and HDFC Life tops the list with a 0.8 cut. JSW Steel, 0.7 down. BPCL, 0.6 down. Tata Steel, JSW Steel, both steel stocks are down about 0.6, 0.7. M&M, HCL Tech, Kotak Mahindra Bank, Maruti Suzuki, Eicher Motors are all starting in the red. Auto stocks generally in the red at this point in time. But otherwise, there isn't much of a method in this red and green because you've got the same kind of stocks like techs are both in the red and in the green. Banks are both in the red and in the green. So at the moment, there isn't much of a method to the kind of gains and losses that we are seeing. Anything specific in the mid-cap stocks, Reema, that you're noticing?
Well, let me start first with JSW Energy, because that started off strong post the acquisition of the O2 renewable energy platform. JSW Energy straight away up nearly 6%. The second big mover is Vodafone Idea. In pre-open, it was up about 8%, but the opening is now a little more tempered, 3% up, after the DOT, Department of Telecommunication, has waived bank guarantees worth 24,800 crore rupees. So positive for, Vodafone Idea. Jyoti CNC deserves mention because there is an Equirus note on Jyoti CNC. They've initiated coverage with an ad rating and a target price of 14.50. So that's pushed the stock up. And this month itself, it's seen about a 13% rally. It's one of the listings of this year, I think, and it's had a very, very strong up move. Siemens also starts trade on a positive note. This is after Chris Wood has also increased his weightage in Siemens in his portfolio. So that's up close to about 1%. Outside of that, you've got a Swiggy, a DAM Capital, MobiKwik, an IRB Infrastructure, a Manappuram Finance. These are some stocks which have opened up with strength. On the way down, you've got cuts coming through in Cigniti Tech. Now, the news here is that over the weekend, Coforge and Cigniti, Coforge has acquired Cigniti. Now, the swap ratio was announced. For 5 shares of Cigniti, you get 1 share of Coforge. But at Friday's closing price, the swap ratio was slightly negative, unfavorable for Cigniti shareholders, which is why Cigniti Tech is down 4.5%. For Coforge, also in the red, and that's because there will be some dilution on account of the share swap. Ola Electric is down 2.5%. Because as Vinny was telling us, there have been some senior level exits. The CMO and the CTO have stepped down and the stock is under pressure. Gujarat Fluoro, at one of its key plants, there was a fire which erupted and unfortunately certain lives were lost. So Gujarat Fluoro also weak in trade. But, other than that, you've got, a little bit of softness coming through in Greaves Cotton. But Greaves Cotton has had such a fabulous run. Just till Friday, the stock was up nearly 50% in the month of December. Pull up a 1-month chart of Greaves Cotton. So some profit booking visible on Greaves Cotton, Vishal Mega Mart, Easy Trip, NMDC, Sale, Enviro Infra. Some of these stocks have opened trade in the red. But all in all, it's a quiet start. Before now, the bias is negative. The Nifty is below 23,800, down 30 points. As we've been highlighting, the 200-day moving average at 23,860 will be crucial. But for now, even 23,800 is not holding. Mid-caps too, down 0.2%. The advanced decline ratio is negative. Banks are trying to stage a bit of a comeback. So the Nifty Bank is now back in the green.
Okay. Now, point taken. Adani Enterprises, I was just wondering why the stock is up in the green. I mean, we don't have a reason for every stock, but there is a Business Standard report this morning which says that Adani Enterprises is likely to see a consolidated revenue growth growing at a CAGR of 17.5%, and EPS, net earnings, profit, that is likely to grow by 45.8% from FY24 to FY27. So it's clearly a longer term thing. But I mean, I don't know whom they're quoting on this, but that's perhaps giving some kind of a positivity on Adani Enterprise. That stock is leading the list of gainers with a 2.6% gain. Adani Ports in close to with a 0.9% gain. And then, as we read out, ITC doing well. But the Gujarat Fluoro alkyl amines as well closed up a plant. We'll get that alkyl amines as well for you. Those are the stocks that are struggling a bit. But all told, very, very flat at the index level. Let's invite our guest on that note. Joining us now is Manish Sonthalia, the Chief Investment Officer at MK Investment Managers. Good morning, Manish. Thank you very much indeed for joining us. Let's start with an overall question first. Have valuations pared down considerably from that 26,000, nearly 500 to 23,500 odd? Does the market look attractive now?
I would say that another 5 to 7% on the downside would give adequate margin of safety. We are not there just yet because obviously it is all well known that current year numbers are going to be very anemic. 1,075 on the Nifty 50 and 1,250 on an average between FY26 and FY27. I think for a 10 to 12% earnings growth, 20p multiples won't hold. And broadly, we are going to trade at median levels of 18p on 1,250. That would broadly give you around 22,500. So there you would have the highest margin of safety, and then we'll have the budget, then you'll have the new US president come through and all of that. So we'll pick up from there. But my sense is first we are drifting on the downside, and from there, towards the second half of this financial year, fiscal 26, we should see enough.
So Manish, morning, this is Reema here. What would be your big bets going into 2025? And given the correction we've already seen, about a 10% so far, and you're anticipating a little more on the way down, how has your view on individual sectors changed? Because some sectors have fallen more than the others. So have you changed your portfolio in the last 3 months?
So the big theme to play in India is that the rupee is going to further depreciate. And obviously, thanks to whatever we are seeing on the current account deficit, etc., there is a propensity for the rupee to depreciate even more from the current level. So obviously, IT and pharma would be the ones which would be in the limelight. They will get a boost from the rupee depreciation. Plus, there is also, this Biosecure Act, which will come sooner than later. It was expected sooner, but it now appears that there's going to be some more time. Apart from that, financials, both lending, and I'm also starting to get quite optimistic on the health insurance companies. These look quite reasonable from a valuation point of view. So BFSI and obviously platform companies, both the digital commerce as well as the capital market space. These are the areas where I think there's a high degree of margin of safety in terms of valuation as well as growth. Not so sanguine about, let's say, the capital goods space or the infrastructure, because obviously this will depend a lot on how the government goes about spending. And that has to do with the allocations in the budget, plus the FRBM 4.6% of fiscal deficit by FY26. All of these things, would warrant a wait and watch as far as the sectoral view on these names are concerned.
Yeah, that's a fair point, Manish. All those things should be on your radar. But would you, you spoke about e-commerce and the digital companies. there also valuations are fairly rich. The Zomatos, the Zaggles, anything you pick, the Nykas. Would you still go at these valuations, or are there attractive valuations in that space?
So 2 points of view, Lata, out here. First, the quick commerce and the food delivery space. There's one school of thought which believes that, we have already seen the best of earnings, in these digital companies. Of course, there's also a point of view that the size of the opportunity is very, very big. The TAM is very big. And when we compare ourselves with China or the developed markets, there is still a long way to go. So from that point of view, I think we're still in the bullish camp, and I would believe that there's room for a lot more players, more than just Zomato, but they'll have to prove a lot of things, and competition is heating up. So yeah, the quick commerce space, we are leaning heavily on Zomato, just that one name. On digital platforms, fintechs, Paytm is one name which we like immensely, because I think the story out here is from a loss net profit in FY24, all probabilities of this company turning net profit in FY26. So that is another digital commerce company that we are liking. Not too many others apart from these two, but obviously we'll be keeping a watch on the new platforms that have got listed, just to see how unit economics play out and how they are going to report profit growth going into the future. But only these two companies for me in the digital commerce.
No, point taken, actually. Paytm, after the severe reverses they faced in 2023, to come back and become net profit, the market has, of course, rewarded them. It is one of the gaining stocks. Can we just pull up the 1 year of Paytm? There it is. Look at the gain that the stock has seen over the year. If you looked at it in Jan, the stock was closer to about 500 rupees. I mean, it's a huge gain that it has seen in the current year. I wanted to add the other sector that was shining earlier this year, power stocks. They're all smokestack stocks, the BHELs, the JSW Energy, of course, has been doing well, but largely they have been smokestack stocks. Anything you like here?
Only the power financiers, Lata. I think valuations are pretty cheap. Plus, on the dividend yield side, also you will have high comfort. Nothing more on the equipment side. I think valuations, etc., are quite prohibitive. Plus the renewables, I think again we are overdoing things as far as the solar side of things are concerned. Very difficult to really assume that there's going to be so much of an arbitrage between a China and in India. This duty protection that you're giving on the modules and the cells, this is going to last too long. And, somewhere down the line by 2030, of course, the growth is going to come off, and probably the valuation that which some of these companies are trading does not give too much of comfort. So not so sanguine about renewables per se. Nothing so on the power equipment side, valuations, etc. Pretty prohibitive on across the spectrum. Transmission, distribution, generation, nothing out there. And obviously, capital goods, again, is a lot to do with the private capex. Private capex, again, is very anemic. And again, valuations leave very little on the table.
So just a few quick questions, Manish. So since you're a bit cautious over the near term, have you upped your cash levels too? And if you had to give our viewers any 2025 top picks, you spoke about Paytm, you like Zomato, you're leaning heavily into it. Any others?
So by design and by policy, I don't take cash levels, but there is good enough number of stocks to keep as cash proxies. Right, so you'll have the large banks, you'll have a Reliance. These are cash proxies. But no, I don't keep cash levels. We are fully invested. As far as the, we can't give recommendations on individual stocks, but I think these four spaces will have ample number of stocks which will relatively outperform. So you'll have the BFSI space, including insurance, and here again, this is one space which I think the health insurance space starts to look very, very attractive now from a valuations and growth perspective. All health insurance companies, they have been beaten down a lot. Then you have your platform companies, both the capital markets as well as fintechs, as well as quick commerce and all of that. Then you have the IT and the pharma. These would be the highest margin of safety sectors according to me, till something changes at the margin. You'll have a lot of developments come through over the next 3 months, and obviously a lot will have to do in how earnings growth play out. But a 10 to 12% nominal GDP growth does not warrant a more than a 12% EPS growth as we speak. So from that point of view, I think these would be the sectors which would deliver more than a 12% earnings growth, and that is why they should relatively outperform, is what I believe.
Okay. Thank you very much. That's absolutely sound logic. Anybody who's able to give you more than 12 is what you would look at. Thank you very much, Manish Sontalia, for taking us through the analysis of the year that will be and what stocks you would pick. And have a glorious 2025 yourself.
Yes, Lata, everybody at CNBC.
Thank you. Well, that point is taken, though I would, squabble a bit about this even 12% GDP nominal growth, because at the moment, the real GDP growth for next year looks like more in the 6 to 6.5% range, considering the beating we have taken in the second quarter. As well, you have to add a lower WPI. The inflation number is mostly WPI and then plus a little bit of CPI. So, we might probably just about scramble to the 10% nominal GDP, which can be a problem. But we will know that only on Jan 7th when the MOSPI gives us its advance forecast for the current year. And on that, of course, the budget will build next year's forecast. Well, with that backdrop on the macros, let's get to micros again. Let's invite some of the very good performers of 2024. We have already seen a couple of them last week. Let's focus now on the cables and wires sector. High volatility in commodity prices did impact margins in the second quarter, but the sector is expecting its margin to normalize in coming quarters. To discuss this, we have Anil Gupta, Chairman and Managing Director of KEI Industries, joining us. Mr. Gupta, good morning, and thank you very much for sparing time for us. Well, first up, just take us through this. Revenues were good. I think all of you have given us some 16-17% revenue growth in the current year, 2024. But margins are miss. How will things pan out for Q3, Q4, and the next year's Q1?
Yeah, good morning, Lata. Thank you very much for this year-end show. The year has been very, very volatile in terms of LME prices, especially of copper and aluminium. And, that has impacted a little bit of margins from 0.5% to 1%. But when the prices goes up and then goes down, so overall, I see that if we see overall for full year, I think this will normalize and it will average out. So we expect that the industry will maintain the guided margins and irrespective of the volatility on the metal prices.
Mr. Gupta, can you just highlight for us or just draw out the demand scenario? You, I think, couldn't pass on all the price hikes, but how is demand emerging? Are there enough institutional buyers, big real estate, projects? How are you looking at demand?
Presently, the demand is driven by 3-4 sectors. One is transmission and distribution is very strong. Secondly, solar power projects, solar developers, that sector is doing extremely well. Third, the data centers, which are coming up in bulk. And then real estate, a normal growth. But industry is also coming up. And we have seen capex coming up in new private sector industrial projects. So, but major is driven by, transmission and distribution and solar and the renewables.
Okay. So what would your dependence be on government-led infrastructure projects? Because we've seen a slowdown in spending. Has that impacted you?
See, I think in our sector, spending has not been reduced, especially in transmission and distribution. I think the spending has been less in cement sector or some of the civil projects or maybe railways, but in electrical sector, in power sector, the spending has not been reduced, and since lot of RDSS projects under the distribution and transmission, new transmission policy, which was declared 3-4 months back, and all those investments are ongoing.
I take your point. In fact, very interesting. You spoke about how transmission and distribution, data centers, all these are giving you enough demand, real estate as well. But can you tell us private capex? I mean, not many people have spoken very positively about it, but you're saying that you're seeing demand. Can you elaborate on that point?
See, we have seen some of the industries in semiconducting space coming up. And, I know that there is a little bit slowdown in cement and steel expansions, but a lot of expansions has been started in last 2 years. And those projects are now having substantial demands, because the cable demand comes in the at a time when almost 50 to 60% project is almost over. So now is the time that they are buying cables and, coming. They can't stop the projects which are already ongoing.
Okay.
But which sectors are these? These ongoing projects?
Steel and cement, and these are the two major sectors.
Okay. So you're sticking to your revenue guidance of 15 to 17% for the year and a margin guidance of 10.5 to 11%, or do you think there's scope to revise it?
I think I stick to the guidance on our growth in sales as well as margins. But since earnings season is starting, so it will not be correct to give futuristic guidance.
Okay, so but for now you're sticking. And what about your 2025 top 3 priorities, sir? What would your focus area be?
See, presently our company is undergoing massive expansion in terms of capex. We are, putting up a project at Sanand near Ahmedabad at an investment of close to 2,000 crore, and first phase of it is expected to be commissioned by June 25, and the overall project will be commissioned by March 26. So that is going to almost, increase our production capacities by 65 to 70%. And we are also considering further capex. Thirdly, we are seeing a substantial improvement in our exports, especially to United States and Europe. And we will see a significant amount of our sales coming up from exports in not next year, but after that, because we have to bring in capacities first to increase our exports.
Point taken. Mr. Gupta, it was a pleasure hearing you out on how you see the sector panning out. It's almost like how India's industrial growth will pan out. You're such an important sector here. Thank you very much. And here's hoping that your capex plans fructify and multiply. And here's hoping that 2025 is a brilliant year for you.
Thank you very much for inviting me.
Okay, well, that's the word coming in from cables and, the cable sector. And I think that was a positive conversation. They have invested a lot in expansions. But the first 15 or minutes or half an hour have not been really positive for the market. It's a deeper shade of red, a 0.3% cut across all indexes. And the rupee, the dollar, which started a good 6 pies cheaper, and the rupee on the, front foot is now, well, the rupee is still on the, front foot, but it's now only 3 pies cheaper than what it was, the dollar, compared to the Friday close. So all over a bit of a reddening in the first half hour. Let's take a break and come back with more management. We will be speaking with Sharad Mahindra, the Joint Managing Director and CEO of JSW Energy, to discuss the company's agreement with O2 Power to acquire a big one, 4,696 megawatt of renewable energy platform. Stay tuned.
Welcome back. JSW Neo, a wholly owned subsidiary of JSW Energy, has signed a definitive agreement with O2 Power to acquire nearly 4,700 megawatt of a renewable energy platform. We have with us Sharad Mahindra, Joint Managing Director and CEO of the company. Thank you very much and congratulations. First, explain the rationale of the acquisition. What does it add to your portfolio? And why did you choose this route of an acquisition over greenfield expansion? And what were the valuations like?
See, this definitely adds a lot of value to us and to our stakeholders, and which is in terms of that we are getting a very, very high quality asset, and which is close a total at a built up to 4.7 gigawatt of capacity, out of which by June 25 almost 2.3 gigawatt will be operational. So, and apart from that, it also gives us a very high quality value in terms of the people and the skill set which we are acquiring. We are seeing that lot is happening in this space in the country. So the people skill is extremely important. So that is also one of the things which we are acquiring.
Your press release doesn't tell us how much you're spending for it. Can you give us at least a sense of the valuations at which the deal has been done and how will you fund it, of course?
When we see in terms of valuation, we always evaluate. Two things are very, very important when we evaluate any opportunity, any asset which is available, is build or buy. So when we see the total built up, when we see 4.57 gigawatt, when it is fully operational, and when we see what is going to be the value, and assuming that if anyone has to build, maybe solar we take 4.25 to 4.5 crores per megawatt of build cost. And as we are aware of wind, build of around 8 to 8.5 crores per megawatt. And then we see that what is that turns to for 4.7 gigawatt. We have found this very, very attractive. And also which is operational capacities current and by June 25, which is giving me immediate cash. I think this is an amazing value at which we have been able to get this asset, this portfolio. In terms of funding, as you see that this is going to take, as we have said, that 5 months timeline when the deal will culminate, that time we will be evaluating this. But we have to remember in terms of funding that what we have reported at the close of H1, we are sitting with a strong balance sheet with 5,700 crores of free cash available with us. And also we have to remember and recall that in April 24, when we raised the QIP, this was also a part that any such opportunity comes, we should be ready. So funding is not at all a problem from internal accruals and raising the debt. It will not be a challenge at all, but exact numbers, how we will be doing and all will be, because the net working capital is a dynamic number till we close the deal. So that will be the time when we'll be exactly coming out that how we are going to do. But we are very, very comfortable with our strong balance sheet.
Okay, got that. What is the PPA signed? Is it done for the entire 4.7 gigawatts? And what is the operational part of the portfolio? When does it come on stream? And what is the EBITDA contribution expected from the acquired assets?
See, one is that, of course, this 2.3 gigawatt by June and will start giving us in terms of the EBITDA, which is going to be there, and the free cash, which will be there. And also by 4.7 gigawatt operational, we are expecting the EBITDAs in the range of around 3,750 crores. So which is a very, very healthy returns what we are going to get when we say that what is the per gigawatt or per megawatt, what is going to be the return this asset is going to give. So this is what we are seeing happening with this asset.
Okay, got that. Well, year-wise, the capacity addition target, will give us an idea. Can you tell us the portfolio addition year on year?
See, as we have said, by June, 2.3 gigawatt, and this entire portfolio is tied up in terms of PPAs with utility and also with part of the states and also in the CNI space. So this is entire portfolio is tied up, barring maybe the last, which we have just got the letter of award for this just few days back of close to 300 megawatt of a hybrid project for letter of award, for which we are expecting that by June 25 we should be in a position to have the tie up in terms of the PPA with that also.
Sir, if you could just comment on this likely tie-up with LG Energy Solutions. Why this entry into EV batteries? Will it be under the listed entity? And, are you looking at a $1.5 billion commitment on that front? What could be your role and your partner's likely role?
See, this is all we continue to explore the various opportunities which we have been maintaining. And if we find anything value accretive, there are multiple discussions which are going on. At the right time, we will be definitely coming out when there is a definitive arrangement or we reach the stage of MOU. The discussion not only with this one entity, but definitely with various entities, we are continuing with the discussion. And this is in line with which we have been maintaining that supply chain de-risking. Whether it is battery energy storage or whether it is the electric mobility, the opportunities, the way country is moving. But at the right time, we will definitely come back. We are just in the process of stage of discussions with various entities. And then we will find that whichever is the best, then we will decide under which vertical we are going to put this. So it is just at the exploratory stage right now.
Got that. Mr. Mahendra, now let me turn to just our projects outside the latest acquisition. KSK Mahanadi Power Plant, if reports are to be believed, you guys are set to get it. What was your bid amount, capacity, and their contribution to your P&L?
This is something we have been declared the successful bidder. But still, that process is on being through the NCLT route, IBC route. Still, the COC is working on, and we will be in a position to comment on the numbers, on the fundings. Once we are in a position where we get the LOI. So we are waiting for that because it is still a bit away because LOI, then it goes to NCLT for the approvals. And also it is maybe a few months from now, we will be in a position, or once we get the LOI, then I think it will be better position to tell that how we are going to fund that. But as I have maintained, this is a running plant with 1.8 gigawatt and another fourth unit of 600 megawatt is significantly built. So it is a very good value, but we will be coming out with the details once we get the LOI and the process is at an advanced stage.
Okay, so from KSK, let me go to the wind turbines. Can you update us on that 10,000 crore fund you have raised for what you call WTG manufacturing or wind turbine graph manufacturing? When will the first turbine come out?
Wind turbine, we have signed, as we have said earlier, the technology license agreement with SANY of China, and the manufacturing setup they have already created. It is already there, and the supply, the rollout for against our requirements will be happening sometime between January and February of 25. Means maximum a month or two, the rollout will start happening. In addition to that, to de-risk the supply chain and to optimize the project cost, we are setting up the blade manufacturing plants ourselves under the technology license from SANY to take care of timely supplies and also to optimize the cost, because we can understand that logistics plays a very, very high cost portion in the blade cost. So we are confident that maybe in 9 months to 12 months time, the blade manufacturing also, we will start for our own captive requirement.
Okay. Mr. Mahendra, it was a pleasure speaking with you, and thank you for giving us a 360-degree perspective on JSW Energy's various activities. You have not spoken just about the current acquisition of that huge platform, but wind and other projects as well, KSK Energy as well. Well, that's the word coming in from the big power guy who's getting just bigger by the day. The markets are still sulking a bit. But Reema, I must come back to you on this IT thingy. I was very excited when I saw the Trump statement. But the top 4 losers today are Infosys, Wipro, HCL Tech and Tech Mahindra. So is it that the market is fearing that talent will run away from India? Or why is the reading negative, or am I just overdoing it?
I think for now, it's still a lot more noise. We'll wait for things to settle down. But I think the street is a bit concerned about what Q3 earnings will unfold for the IT sector. But I just want to put on board a bull versus bear on the tech sector. So there is Goldman Sachs. Today they're saying that we're constructive on the IT sector going into calendar year 2025. So they're forecasting a 7% top line growth for next year, which is better than the 4% in FY25 and better than the 1.5% in FY24, which basically means after 2 muted years, they're saying growth will accelerate. Now, this will be driven by pickup in the US economy, so that's 60% of your revenues. Sectors like BFSI, technology, consumer are all showing positive signs. There is positive commentary from the US banks. So whenever, Goldman Sachs has done their, financial services conferences, the commentary from the US banks, which are clients of IT companies, has been positive. Accenture numbers were strong. And even they conducted an IT spending survey. And the outlook for spending going into next year is positive. That said, in the near term, they're saying there could be revenue and margins pressures due to company-specific factors. So TCS's revenues, that's the first one to report their numbers, I think on 9th of January. There is a ramp down of the BSNL deal, so that will impact TCS. Wage hike or pass-through impact on LTI Mindtree. So in the near term, Q3, there could be some pressures, but they expect most of the pressures to be in the street numbers by mid-January 2025. Also, elevated valuations do cap the upside, and Europe is an area of concern. But still, Goldman Sachs is constructive going into calendar year 2025. Investec, on the other hand, says the risk-reward is unfavorable as they continue to see a potential for marginal downgrades when the numbers come out. IT stocks are trading at a premium to Nifty despite lower growth. Deal wins have weakened. The headwinds from AI is still far away, but for now, they're worried about the valuations and deal wins. But in the entire IT pack, their preference lies for Zensar and KPIT technology.
That's really neat, the bull and the bear case for IT companies. Well, we have to take a break, do we? Okay. I think a bit of a market check is called for simply because the banks have forged to the front. I mean, at one point in time, we had a deep 0.25% cut on the Nifty Bank. It was the worst performer. And now it is dragging the Nifty up along with its own heft. So that's something I would, really look out for. Banks at this point in time on the front foot. Maybe we want to pull up HDFC Bank. Usually that's one bank which has the capacity to pull up, the entire sector itself. At the moment, Union Bank, Indian, IDFC, Federal, PNB, that is mostly PSU banks and small banks or other mid-cap banks are leading. But look at ICICI Bank, 0.4 up. That can mean a lot for the index as a whole. So it's not really an HDFC Bank pull-up. It's actually across the board with the banking sector now moving up to a 0.11. That's 0.11 kind of gain that we are seeing. HDFC Bank is actually in the red, but everybody else is pulling up the index considerably. Speaking of banks, let's get to PNB Housing. PNB Housing, it's expecting, it's already announced that it's expecting its retail loan book to reach 1 lakh crore rupees by FY27. So that's 2 years from now. The company is also intending to increase its non-housing finance book to about 30% by giving loans to those whom loans against property, that is to people who already have a home loan. To discuss this and more, we have Girish Kauski, Managing Director and CEO at PNB Housing Finance, joining us. Girish, good morning and thank you very much indeed for joining us. But first, let me discuss the housing finance space itself. We saw a lot of luxury housing purchases and projects. We haven't heard much about affordable housing, the space where you lend. Your thoughts, what's the demand like? What kind of growth are you seeing in the coming year itself? Let's postpone FY27 discussion for now. How do you think FY26 may pan out?
Well, good morning, Lata. I think if you look at the market, all the segments, whether it is luxury, super luxury, emerging, affordable, I think all are doing well. First, let me talk about affordable. We are seeing very good traction. As of last quarter, we were very close to 3,000 crores. The plan is to get to 5,000 crores in affordable book by end of this year. So we are seeing very good trend, and not just in affordable, even in emerging and in prime. Of course, there are a couple of markets because of temporary hitches. It's slightly slow, but I think market is very good. We are seeing very good.
So is there any geographical guidance with respect to your loan growth in the affordable housing segment as you plan to scale it up?
We are a nationwide presence, so we largely focus on south, north, and west. So for us, south is slightly more, followed by west and then north. So it's almost similar, so not much of a difference. But affordable space is one space, which has gained a lot of traction in terms of demand. And we are seeing very good growth in all the three regions, that is north, south, and west.
Okay, Girish, you've spoken about at least 30% of your book going as looks like consumer durable loans to those who have, those who own property or those who have a home loan. Isn't there a danger over there of over-lending? Considering what Reserve Bank has drummed into our ears, why are you so confident that you will be able to do that? If you gave a CD loan to someone who already has a home loan, there is a overlending fear also, isn't it?
Yeah, Lata, I think we are not into CD business at all. We are only into
so what is this property loan against property?
Yeah, both into housing and non-home. Non-home comprises of loan against property, lease rental discounting, and loans to commercial spaces, office spaces. These are small retail outlets. Now, if you look at our entire portfolio, our retail book is 68,000 crores. We plan to take this to 1 lakh crore by FY27. Out of the 68,000 crores, loan against property or the entire non-home book is about 28%. So we are talking about increase by 1% or 1.5%. I think that is not at all big given the mix and the demand in the market. So these are loan against property where the LTV would be quite low. It will be average about 50-55%. And this is for end use. This is only for business end use what we give. So we don't see any challenge in this. And our focus is not really to increase non-home. Our focus is really on home loans. We want to increase our home loans. And you also spoke about the growth for this year. We had guided the retail growth of 17%. As of last quarter, we've already reached 16.2. So hopefully we'll be able to breach that this year. Our retail growth is going to be over 17% this year. And for next 2 years, it should be in the range of 18 to 18.5%, 19%, thereby taking the retail book to 1 lakh crore. Out of 1 lakh crore, affordable book will be 15,000 crores. Emerging will be about 25,000 crores, and the balance 60,000 crores will be prime.
Okay. Oh, excellent. You answered some of the questions that were in my head. I was asking you for the arithmetic of this 1 lakh crore. Thank you very much for that. But, let me come back to the point you made about, going into loan against property, especially in the commercial space, lease renting, etc. What does that do to margins? Will these improve margins? As also your ROE, ROA. It's a 13% yield now, right? What kind of an ROA are you looking for now?
So if you look at the entire mix, as I mentioned to you, about 28% is non-home. I think that trend will continue. That is not going to significantly lift the yield. What will increase the yield and thereby increase margin is the segment shift. If you remember 2 years back, we were predominantly into super prime and prime. Over the last 2 years, what we have done is we've done two things. We have completely exited super prime. We are reducing our exposure to prime segment. We started affordable little over 2 years back, and the book will reach 5,000 crores by this year end. That will come at about 12.5% yield. Number one. Number two, emerging we started this year. Emerging, the book will be about 25,000 crores by FY27. This will be at a higher yield compared to prime. So because of segment change, because of control on cost of borrowing, the margins would improve. not because of the shift from home to non-home, which will be hardly 0.5%, that's all.
Okay. All right. Just hold on, Girish. We have the listing of the three companies. We've got Sonoris, we have that hospitality company, and we have Ventive, right?
Ventive Hospitality,
Ventive
which is the owner of Marriott, Hilton. It's a Blackstone-owned company, but the biggest one is actually Sonoris Healthcare.
Yeah, Sonoris Pharmaceuticals.
It had a very strong subscription of 94 times. The issue price was 391 crore, and it's listed straight away at 600 rupees. Ventive Hospitality has also had a good debut. It's about a 12% uptake on Ventive Hospitality. So the issue price would be close to about 17,000 crore rupees. This was a pure fresh issue. It was a 1,600 crore fresh issue. There was no offer for sale for Ventive Hospitality. Carraro India is a bit subdued, at least in opening, but the big one today is Sonoris Pharmaceutical, 50% at open. The company had raised close to about 582 crore rupees by the IPO. Investors lapped it up and they're being rewarded. So 590 rupees at opening for Sonoris.
I'm not surprised because Sonoris was using only 82 crore as OFS.
Yes.
The remaining 500 crore is getting invested in the company. That would have been taken positively, and it is far more, in terms of its PE. And I think 45x, at current valuation, it would be 56 times. Oh no, that makes it a little expensive compared to Ajanta Pharma, which is 43x, and Gland Pharma, 37x.
Yes.
Makes it a little expensive, but I guess getting points for the fact that it is entirely getting invested. Sonoris, excellent listing, 50% higher, in keeping with the very good listings that we have had. We'll come back to these listings after the price settles down somewhat. Girish Kauski is still with us. Girish, thank you very much for your patience. Just leave us with how are you looking at housing demand itself? Has that been very good? You said that you will go higher and higher in terms of the rate of growth, but is there adequate demand?
So there is actually very good demand. All the four segments, super prime, which is super luxury, prime, which is luxury, emerging and affordable, all the four segments, the demand is quite robust. What has happened is that, if you look at Q3, couple of states, for example, Karnataka, there has been slight delay in registration. If you look at MP, there has been some challenge with registration. If you look at Maharashtra, because of elections, there was a bit slowdown in terms of the process of getting the registration done. So these are all intermittent challenges, nothing to do with demand. Demand is quite
Girish,
robust.
okay.
As I mentioned to you, we have not seen from April till now any slowdown. Actually, we are seeing increased demand in all the segments.
Okay,
and which is why I said that.
Girish, 1 minute. I should have phrased it differently. There has been a liquidity tightness in the market. Raising money has not been easy for banks itself. So it's not any better for NBFCs and housing finance companies because banks have been told not to expose themselves too much to this segment. So are you able to pass on that cost, the higher cost of the money that you raise?
So if you look at last couple of quarters, we've been bringing the cost of borrowing down. And we have enough and more liquidity, and we were able to borrow from banks at competitive rates. However, NCD rates have come down, so there is some exposure to CP. And this year, we've got 5,000 crores from NHB, and that comes at a lower cost. So absolutely, there is no challenge, for us or maybe even to the industry at large. I'm talking about housing finance industry. In terms of liquidity, there is absolutely no challenge. Only thing is the bank cost has slightly gone up, and therefore we can see shift towards ECB, we can see shift towards NCD and to a certain extent CP and NHB borrowing. Otherwise, there has been absolutely no challenge on raising funds.
All right. Thank you very much, Girish. That makes us end the year on a high note. The kind of optimism you have injected into the conversation. Here's wishing you a very good, equally brilliant 2025 as well.
Thank you so much, Lata.
Okay, so that's the word coming in from the housing finance company, PNB Housing. Very optimistic on the year that will be and as well on the year that's just ending. The markets actually are now turned optimistic we still have the IT companies in the red, but the extent of the redness has reduced. In fact, if you looked at the last 1 hour, the ones that have gained the most are Tech Mahindra, Infosys, TCS, HCL Tech. All of them from their lows are up about 1/3% or 1/4%. Let's invite our technical expert, Shilpa Raut is joining us. Shilpa Raut of Prabhudas Leeladhar. So Shilpa, after the first 1 hour, what are the trades?
The first 1 hour has been, really rocky, but now we see that there's a turn of events and we see the market turning positive. So I have two buys. The first one would be a buy in KEI. KEI is definitely heading towards 4,500 to 4,600 zones. With a stop loss of 40 to 50, one can definitely stay long here. The other one would be a buy in APL Apollo. APL Apollo is also looking very good with a support at 1,500. Look for targets of 1,580 to 1,620. The same we have recommended in Prabhudas Leeladhar today as well.
Okay, thank you very much for that, Shilpa. We will touch base with you later on in the day. At the moment, I'm not surprised. KEI, Anil Gupta's whole approach sounds very positive. Seeing so many verticals, investment in power, in T&D, in data centers, in private capex, all of them are pushing the sector. So KEI on high, even technically, we are given to understand.
And even exports are picking up, including in Europe, not just US. But he spoke about exports also, contribution of exports significantly rising once the new fresh capacity comes on stream. We'll get into a break. On the other side, Manisha will join in to talk about commodities.
Welcome back. It's that time of the morning when we have to get the commodity cues as well. Manisha Gupta is waiting by. Manisha, what's the one commodity you think we should track today?
I think you should look at metals today because there is still some volatility continuing into this one, and that is because the dollar index is moving and you have various other pointers to discuss as well coming in. I want you to look at copper prices because this seems to be recovering from its lows. Remember, the prices did decline 2% on Friday, but currently in the Asian markets, we are trading 1/4 to 0.5% on the higher side. So it's back above $4 a pound, and we did see prices go below that as well. So some psychological supports being fixed up there. For the year, though, the prices are up by nearly 5.5%. I want to take you to also on what China has done, where China has pledged nearly, China has said that they will cut import tariffs on certain recycled copper and aluminum raw materials starting 2026 there. Well, there also is concerns. This is about aiming to increase imports, quality imports that is, and expand domestic demand and numbers itself. The second important thing that China seems to be doing is that they have issued 3 trillion yuan in 2025 in special treasury bonds. China also says that that they have allowed the local governments or officials to broaden the investment with key government bonds. So even as we are still waiting for 2025 to begin, China already has come out with various measures, statements, and opening up of markets as well in sense of tariffs also. The other thing is that the copper smelting numbers, well, remember, they have been constantly declining on quarter in the previous year. For this first quarter 2025 as well, the copper smelters have set lower processing charging guidance. If you look at the previous quarter, we were at $35 a ton. For first quarter 2025, it has been put down by nearly 28 to 30% to $25 a ton. That tells you that the copper concentrate is still scarce, and that is the reason you have seen these prices decline. That should be supportive, by the way, for the copper prices. Going forward into the next year, then, the markets will wait out for Trump taking over and the kind of tariffs that puts on. Markets do believe that the all-time highs that we saw in 2025 perhaps is not a possibility for 2025 there. So 10,500 to 10,000 is what the view is coming in for the copper prices from UBS, Goldman Sachs, Citi and JP Morgan. But there are some banks and brokerages looking at prices below 10,000 as well. Currently, we have copper trading at around 9,100. So 9,400 to 9,900 could be an average going forward, is what Bank of America, ANZ and ING kind of banks believe. So it's going to be a tight range for copper in the next year. Markets would want to see on how is the availability for concentrate and, of course, demand coming in from China.
Okay, thank you very much for that comprehensive analysis of metals. Obviously, very crucial for the stock markets as well. Thanks, Manisha. Let's get to stocks again. We told you about that unfortunate accident, gas leak at Gujarat Fluorocarbons. Upasana is joining us with more details on what it might mean to the company. Upasana.
The stock remains in focus today. Well, a gas leakage at company's Dahej plant in Gujarat has led to the death of 4 workers on 28th of December. Mind you that the gas leakage was mainly caused by a valve that released toxic gases, leading to death of workers. As a result of this incident, operations at the plant are temporarily disrupted, is what the company has indicated. And further, company also says that all the assets are adequately covered under the insurance policy of the company. Now, according to the recent government data that was released, the government says that the number of gas and chemical leakage accidents in India has more than doubled to 30 in the last decade, with Gujarat accounting for the majority of the incidents in 2023. So that is one of the key data that we really need to look into.
Okay, thank you very much for that. One hopes that any more casualties at least will not come. That's the sad part. Thank you very much for updating us, Upasana. Let's take a quick break on that note. On the other side is our special segment, It's the Economy. I'm going to connect with Dr. Pranab Sen, former Chief Statistician of India and a well-known economist. Also, Mridul Sagar, former ED at RBI and also formerly member of the RBI's MPC. What we're going to discuss is whether the way in which inflation is going to be calculated is about to change and whether that will have a positive impact on interest rates and growth. Stay tuned, we are back with that very important discussion for both bond markets and stock markets. Welcome to It's the Economy. A lot of discussion or issues have been thrown up on the very calculation of inflation. First, should amount of food in the CPI basket be brought down? We just on Friday had the household consumption survey, the second edition in 2 consecutive years come out, and that's indicating that amount of money that households are spending on food is down. So, should the weightage be brought down? Secondly, the big question that the MOSPI, the Ministry of Statistics, has thrown at economists: how should you treat the free food that is available under PDS? Is that weight getting distributed to others, or should it be counted as some expense and given some weightage? That's a big question that's been thrown at us. And the third one is the finger pointing in the November monthly review of the economy by the Finance Ministry, saying Reserve Bank's tightness created the slowdown. Let's see how much we can fit in, but we have 2 stalwarts to discuss this. Dr. Pranab Sen, former chief statistician of India and who knows a thing or two about how these indexes are put together, and Mridul Sagar, now professor at IIM Kozhikode, but he was a member of the MPC and should know a thing or two about how we should look at the CPI itself. Dr. Sen and Mridul, thank you very much indeed for sparing time for us in a holiday week. Dr. Sen, you first, sir. First, is it very clear from the 2 household surveys that food needs to be given a lower weightage? If yes, how much?
Absolutely. I mean, look, every time we've revised the CPI, we haven't done it too many times, the food share has gone down. And that's in the nature of consumption behavior. So the food weight will go down and should go.
Okay, you know what the numbers showed is that it has come down in rural areas in 2011 from 53% to about 47% now. So should we expect a substantial downtick? I mean, you're looking at some 3 percentage points lower or something like that?
Yeah, it will be a substantial one because, you know, you're changing the basket after quite a while now.
Okay. Mridul, your thoughts, if this comes into effect as of FY26, will we see a step down in inflation? And should the Reserve Bank already take this into cognizance, that food is anyway is exaggerated in its weightage? And will that be a reason to be a little more sanguine about rate cuts in the coming policies?
I think I'm totally in agreement with Dr. Pranab Sen. I mean, it's no brainer that the weight has to come down. And that's the standard Engel's law we have in economics. As incomes rise, the share of consumption in food comes down. And that's what we are seeing consistently when these consumption expenditure surveys are done. I think the ballpark number you mentioned of about 3 percentage point weight fall should be roundabout right, could be marginally higher, but not very different from 3%. So from the present weight, we could see it fall around 42. It's hard to pinpoint exact numbers because we do not have the full details of the consumption expenditure survey. And I'm sure MOSPI's expert committee, which is going into the base revision, will do the necessary exercises at item level and then come to the subgroup level, then to the group level, and then arrive at what is the right weight. So in some sense, you could see inflation rates month to month could vary, but could sort of fall by about 0.2 percentage points. Not significant enough to alter the monetary policy compulsions. The monetary policy still faces that hard dilemma that inflation is higher than what is intended while growth is slowing down.
Oh, okay. It's only 0.2%, is it? Oh, I thought the impact would be a little more because last few months, it is food inflation that has been rising at 8 to 11% in the last 18 months, Mridul. So if food is like taken it so high and the weightage is going to come down from 46 to 42 approx, then it's only 0.2 that it will bring the overall inflation down?
I guess 0.2 to 0.3 should be the ballpark number.
Okay.
You can't really pinpoint on 1 month's data. Each month would be very different. So,
okay. So you don't think
in the sense
MPC...
the rates are year on year again. Okay. So you have to recognize that the CPIs would change year on year.
Okay. Fair enough. Okay. I was running away that maybe after seeing the second survey, the first survey already told us, and that was reiterated by the second survey, so I got a little excited. Well, Dr. Sen, the next point of PDS, the MOSPI themselves have invited your opinion, and I'm hoping Mr. Saurabh Garg is going to look at this interview. What's your sense? How should PDS free food be treated? Should the weight merely be distributed to other food items, or should it be distributed to all the other non-food items as well? What's the advice?
No, free food, anything which is free should not come in the CPI. Okay?
Why
what
that?
Happens is that the weights are taken from the Household Consumer Expenditure Survey. And that technically, free food grain should have zero weight.
Okay.
Because they are not spending anything on it. It's a part of their consumption, but it's not part of their expenditure. So free food should never find its way in the basket. The weights will readjust automatically. And it will be across the whole spectrum of the consumption.
Food and non-food. Okay, Mridul, would you want to add to that? Since the MOSPI has raised it to the level of a national debate and asked comments from people like you. Is that the way? I mean, Dr. Sen's point of view would be you may perhaps add food when you count the monthly expenditure, or income of a person, because that food is coming, but certainly not in inflation. My rupee, how much will it buy this week and next week, will not be influenced by the free food at all. So is it clear PDS food out?
It's out for one very simple reason. So while what Dr. Pranab Sen is trying to explain is very, very true, because the CPI manual, the CPI manuals are prepared by very 5 international bodies join and sort of prepare that manual with great care. And they clearly have recommended that the option is to just take it out. Anything which is free should not figure part of the CPI matrix. The problem here is what happens if prices are no longer free? And that could also add to considerable volatility, and we'll have to sort of grapple with how to include it in terms of as a new item or something like that. But technically now we don't even have prices for the PDS part under the National Food Security Act.
That's right.
It's a free distribution of food grain.
Mridul, 1 minute.
That will not have a price. So you can't even calculate an index even if you want to.
That's it. Mridul, 1 minute. I'll tell you why it's probably a very innocent objection. But when I was just discussing with colleagues in the newsroom, the immediate reaction is, but hum log ko to kuch nahi mil raha na. We are not getting anything free. It's probably going to, half the population, but not to the entire population. And even targeted populations are not entirely reached. We know that there is a problem in delivery, at least in some sectors, in some geographical areas. So is it a given that it should not be included at all, or should something be included, Mridul?
So if you have prices, that part of the PDS can figure into the calculations. But what is distributed as free cannot really figure into this, because you don't even have prices, and the international manuals do suggest that it's best to keep them out, because then you will have all kind of problems if you bring them in. In terms of the volatility, you can try imputing something. What you will impute is not clear. So I think it's best you sort of keep them out, but then consider at the point where you might not have a PDS which is free, then you will have to take a call on how to deal with it.
Okay. Well, at the moment, it is a
And that will add to the volatility in the inflation rate. So,
Fair point.
in some sense, keeping it out may be the better option. It's a very vexed issue, Lata. It's best left to the expert committee which is going into this whole issue to see if some imputation can be carried out. But my sense is simply it should be kept out to keep things simple.
Okay, we are not able to come to the most important question that I wanted to ask you all and maybe postpone it for another day or continue it. Dr. Sen, does all this mean that the Reserve Bank has overestimated food? First of all, in the basket itself, it is lower, and there is the free food calculation also that's included. All told, and there is this, of course, finance ministry accusation that liquidity perhaps was kept too tight. Macroprudential rules also came in. Is the accusation fair that Reserve Bank probably kept things too tight?
Not at all. Look, Lata, the weight of food can come down. PDS may be free, so you omit it from the basket. What's driving inflation are essentially fruits, vegetables, meat, fish, and eggs. Now, the fact of the matter is that even if the share of food comes down, within the food category, you're going to get the weight of cereals, which have been completely stable, going down. So it's not going to affect your inflation downwards. It may affect it upwards, for all we know.
Okay. All right. Okay. Well, just 10 seconds left. Mridul, you want to add, is the accusation fair?
I am with him. On a larger ground, I would say that it's not fair to blame the RBI because RBI doesn't produce the statistics. It's produced by the competent statistical authorities. And where things had gone down wrong have been substantially corrected. I'm really admiring the way now work is going on in MOSPI. And you would see a whole lot of new statistical improvements coming in all fields. Apart from that, if inflation is high above the target, then you can't just blame RBI for the growth because the mandate is very clear of the inflation targeting framework. And the growth has to be addressed from complementary policies on the fiscal side and other administrative measures. Yeah.
Fair point. Thank you very much, gentlemen. But I think we would still have one more debate on whether the finger pointing was fair at all. I wanted a little more of your views on that. Thank you very much, Dr. Sen and Mridul Sagar, for enhancing our understanding of what we are in for in terms of the new CPI calculation. Meanwhile, the markets have gotten greener as far as the Nifty Bank and the mid-cap index is concerned. Both of them up 1/3% and 1/4%. And on that positive note, we wind up on Bazaar and hand over the baton to Chartbusters after a break.